Do you notice how traditional financial institutions seem terrified of Bitcoin, yet they keep finding sneaky ways to get exposure to it? Jeff Walton, a seasoned reinsurance broker and one of the leading voices on MicroStrategy's Bitcoin strategy, reveals exactly what's happening behind the scenes. In today's discussion, we'll examine 3 central points: how regulations are forcing institutions to use creative vehicles like convertible notes to get Bitcoin exposure, why major insurance companies now view Bitcoin as essential for portfolio management, and how an entirely new credit system is forming around Bitcoin acquisition. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. The most shocking part comes in our final segment, where Jeff explains how this is creating an unprecedented feedback loop in the financial system. But first, let's look at how major institutions are being forced to enter Bitcoin through back channels due to regulatory constraints.
Yeah, 100%. It needs to be paired with insurance, and yet none of these insurance companies can hold it. But you know what they can hold? They can hold MicroStrategy equity. They can hold convertible debt of any type. They can hold convertible debt ETFs. They can hold all these other products and leverage against it. But how an insurance company works is you're matching assets to your future liabilities. And those liabilities have different durations, right? So you have property's got a short duration, but then you've got casualty, workers' comp, life insurance that all has long tail duration. And if you're thinking about, if you just reframe how you see Bitcoin and you think about it in 4 or 8 year periods, longer term horizons, you can start to match that asset to a longer term horizon duration.
What Jeff is explaining here perfectly illustrates the first key point of our thesis: how traditional financial institutions are being forced to gain exposure to Bitcoin through creative means due to regulatory constraints. These massive insurance companies, which control trillions of dollars in assets, literally cannot hold Bitcoin directly because of regulatory restrictions. But they found a fascinating workaround. They can hold things like MicroStrategy stock or convertible debt that gives them indirect exposure to Bitcoin's price movement. Think about how an insurance company operates. They take in premiums today, but might not have to pay out claims for decades, especially with things like life insurance or long-term disability coverage. They need to make sure they have enough money set aside to cover these future obligations. Traditionally, they've invested in bonds and other supposedly safe assets, but with inflation eating away at the value of dollars, they're realizing they need something different. Bitcoin could be perfect for this because it's designed to appreciate over long time periods, but regulations prevent them from buying it directly. What we're witnessing is these massive institutions finding increasingly sophisticated ways to get Bitcoin exposure through traditional financial products they're allowed to hold. It's like they're being forced to use side doors to get into the Bitcoin party because the regulators won't let them use the front door. And this regulatory constraint is actually driving innovation in financial product development, creating entirely new vehicles for Bitcoin exposure that didn't exist before. We've clearly seen how regulations are forcing creative solutions, but wait until you hear how modern portfolio theory is completely changing how these institutions think about Bitcoin as an essential asset. And make sure to stick around for our final segment, where Jeff reveals how this is creating an unprecedented credit cycle in the financial system.
It's a complete no-brainer, in my opinion, is at least adding some of this convertible debt to your balance sheet, right? Like, insurance companies subscribe to Markowitz modern portfolio theory. Markowitz modern portfolio theory being the mathematical concept of diversification, right? If you have a portfolio of diverse assets, if you add a new asset with different risk return metrics to that portfolio of assets, it improves the return and reduces the risk of the entire portfolio. And now you're these insurance companies aren't acting on these new assets, and so they're leaving risk and return on the table. Reduced risk and increased return on the table. They're leaving it.
Yeah.
It's a huge opportunity.
What Jeff is describing here addresses our second key point: how major financial institutions are recognizing Bitcoin as a necessary portfolio diversification tool. He's referencing modern portfolio theory, which is basically the Bible of how big institutions manage risk. The key insight is that you can actually reduce the overall risk of your investment portfolio by adding assets that don't move in sync with each other. Insurance companies live and die by this theory. It's fundamental to how they operate. What Jeff is pointing out is that Bitcoin has unique properties that make it an ideal asset for diversification. It doesn't move in correlation with stocks, bonds, real estate, or really anything else. So by modern portfolio theory, insurance companies are actually increasing their risk by not holding Bitcoin or Bitcoin-related assets. At 1031, we see this playing out in real time as more institutional investors realize they need Bitcoin exposure, not just for returns, but for basic portfolio management. Everyone knows about Fold. It's the app where you can earn the most Bitcoin rewards for everyday purchases. Fold now lets you double stack rewards with gift cards. Use your credit or debit card to buy gift cards and earn both credit card rewards and sats. Fold gift cards help you grow your stack with every purchase. If you're not shopping with Fold gift cards, you're leaving sats on the table. Get a 20,000 sat welcome bonus. Go sign up now at foldapp.com/Marty. This is revolutionary because institutions aren't just buying Bitcoin because they think it might go up. They're buying it because their own risk management frameworks are telling them they need to. They're literally leaving money on the table and taking on unnecessary risk by not having exposure to Bitcoin. Think about what this means. We're moving from a world where Bitcoin was seen as this crazy risky bet to one where not having Bitcoin exposure is seen as the risky choice. We've now seen how regulations are forcing creative solutions and how portfolio theory is driving institutional adoption. But perhaps the most fascinating part is still to come. How these dynamics are creating an entirely new form of credit creation specifically for Bitcoin acquisition. The implications of this for the entire financial system are staggering.
That's exactly how it would work in insurance as well. Because if you add Bitcoin on your balance sheet or Bitcoin correlated products, your ability to lever increases. So it is... it's kind of a similar design and situation in the insurance marketplace as well. It's just a little different because as the value of the underlying product increases, your ability to lever against it also increases. So Bitcoin's effectively eating TradFi from the inside out, and nobody really knows about it. It's just starting from the inside, and it's going to eat its way out.
And it's another thing Bitcoiners have been saying for a while. It's like Bitcoin just incentivizes greed in the best way possible because it's net positive for anybody that holds Bitcoin. And even if you don't hold Bitcoin, it's going to be good for society because we have better money. But that's what the incentives of Bitcoin have been weaponized and recognized by TradFi. And the results speak for themselves. Like, to think that this is going to stop is insane because all these traders, all these funds, all these capital allocators have benchmarks to hit and hopefully surpass. And the dynamics that are played, if you tap into these markets, you're almost guaranteed to outperform the benchmark. And that's just going to feed on itself.
Yeah. I mean, think about everybody that bought these convertible bonds from MicroStrategy and they just outperformed the entire market by 10x. And then they outperformed Bitcoin and all this other stuff. That money is not going to leave this trade. Right? Like when the debt is converted to equity, they're going to sign up for the next one.
What Jeff is revealing here addresses our final and most profound point, how these institutional dynamics are creating an entirely new credit cycle specifically for Bitcoin acquisition. Let me break down what's happening. When companies put Bitcoin on their balance sheet, it actually increases their ability to borrow money. As the Bitcoin goes up in value, they can borrow even more. It's creating this fascinating feedback loop where traditional finance is essentially creating new money specifically to buy Bitcoin. Think of it like this. MicroStrategy issues convertible bonds, which investors buy because they've been incredibly profitable. When these bonds convert to equity, because Bitcoin has gone up so much, those same investors immediately want to buy the next round of bonds. The money isn't leaving the system. It's staying in and actually multiplying. This is completely different from how most people think about Bitcoin investing, where you just buy and hold the asset directly. What's happening here is that the traditional financial system is creating entirely new credit instruments specifically designed to accumulate more Bitcoin. What makes this particularly fascinating is how it ties together all three elements of our thesis. The regulatory constraints we discussed in our first point are actually driving the creation of these new financial products. The portfolio theory requirements we covered in our second point are creating massive demand for these products. And now, as Jeff explains, this is resulting in an unprecedented credit creation cycle specifically for Bitcoin acquisition. We're witnessing Bitcoin essentially consuming traditional finance from within its own structures. The really profound part is that most people, even in the financial industry, don't realize this is happening. Every time one of these Bitcoin-backed financial products succeeds, it creates demand for even more products, which leads to more Bitcoin buying, which makes the existing products more successful. It's a self-reinforcing cycle that's happening right under everyone's nose, and it's fundamentally transforming how institutional capital interacts with Bitcoin. Will Bitcoin's credit cycle cause the next financial crisis? Let me know in the comments. I read every single one. And if you found this institutional credit cycle analysis interesting, you'll want to watch our breakdown of Ethereum's structural problems. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.